The income statement moves from revenue down to net income, and each step down represents a different layer of costs being subtracted. Start with revenue, recognized when a company satisfies a performance obligation, which usually but not always means when goods or services are delivered, not necessarily when cash is received. Subtract cost of goods sold, and you get gross profit. This tells you how efficiently the company produces or sources what it sells, independent of overhead. Subtract operating expenses, things like selling, general and administrative costs, R&D, and you get operating income, often called EBIT, earnings before interest and taxes. This is a favorite exam number because it isolates how the core business performs before financing decisions and tax situations muddy the picture. From operating income, subtract interest expense, the cost of debt financing, to get pre-tax income. Subtract taxes, and you land at net income, the famous bottom line. A few things the exam tests hard: non-recurring items, one-time gains or losses that shouldn't be projected forward when you're forecasting future performance. Analysts typically strip these out to see the real recurring earnings power. Also, earnings per share, basic EPS, uses the weighted average number of shares outstanding. Diluted EPS assumes conversion of things like convertible bonds or stock options into shares, which is why diluted EPS is always equal to or lower than basic EPS. More shares in the denominator means less earnings per share. Recap: revenue down to gross profit, down to operating income, down to net income, each subtraction isolating a different layer of cost. Watch for non-recurring items distorting the picture, and remember diluted EPS is always less than or equal to basic EPS. Next, the balance sheet.